Wall Street will teach you how to enter a trade. It will never teach you how much to put on it. That gap between knowing what to buy and knowing how much to risk is where most retail trading accounts quietly die. Not from bad analysis, not from wrong predictions, from the sizing decision that happens before the trade even begins, made with no framework, no formula, and no understanding of what the number is actually doing to the account's long-term survival. The books give you charts and indicators and pattern names. They give you entry signals and trend definitions. Position sizing, the one variable that determines whether a losing streak destroys you or merely inconveniences you, gets a page and a half if you are lucky. And the advice is almost always wrong for the person reading it. These 5 rules are not in the textbooks. They exist in the internal risk guidelines of professional trading desks, in the protocols of proprietary firms that manage real institutional capital, in the quiet understanding that separates the traders who survive long enough to develop an edge from the ones who never get the chance. They are yours now. Let me describe what position sizing without these rules actually looks like, because most traders reading this are doing exactly this right now without knowing it. They open a chart and see a setup. It looks strong, better than yesterday's setup. They feel more certain about it. So they take a little more than usual, maybe 1.5 times what they normally risk. The trade loses. They open another chart. This one also looks good, maybe not as good, so they go back to their normal size. It wins. Tomorrow they find a setup that looks obvious, the kind that feels impossible to miss. They double their size. It loses. They end the week down more than the math of their win rate should produce, confused about why a system that seems to work keeps failing to grow the account. The answer is not in their win rate. It is in the invisible hand that keeps sizing up on the losing trades and down on the winning ones. Because confidence and quality are moving in opposite directions, without the trader ever recognizing the pattern. An amateur sizes based on how certain a trade feels. A professional sizes based on a formula that has no feelings. Let me tell you about Yusuf. Yusuf had been trading for 2 years when he finally tracked down the real cause of his account's frustrating flatness. His win rate was 48%, respectable for his system. His reward-to-risk ratio averaged 1.6 to 1. On paper, those 2 numbers should have been producing steady account growth. Instead, his account had moved from $22,000 to its current $23,500 over 24 months, less than 7% total growth in 2 years of real work and genuine analytical effort. When Yusuf went back through 12 months of trade records with one specific question, did I size up on winning trades or losing trades? The answer was undeniable. On his 10 largest winning trades, his average position size was 0.9% of account risk. On his 10 largest losing trades, his average position size was 2.3% of account risk. He had been, without ever consciously deciding to, doing the exact opposite of what position sizing is supposed to do. The trades that felt most certain, the ones with the clearest narratives, the most visible patterns, the strongest emotional conviction, had the worst actual outcomes. And he had been betting largest on them, month after month, for 2 years. After implementing all 5 rules in this video, Yusuf's account grew from $23,500 to $33,800 over the following 5 months, a 44% gain, with consistent 1% sizing applied uniformly across every trade, regardless of how certain or uncertain any individual setup felt. Here is the math that explains why sizing consistency compounds over time in a way that confidence-based sizing never can. A trader with a 50% win rate and a 1.5-to-1 reward-to-risk ratio, risking 1% per trade on a $20,000 account, takes 20 trades in a month. 10 winners at $300 each, 10 losers at $200 each. Net result, $1,000 profit. Account now $21,000. The same system, same win rate, same reward ratio, but with sizing that swings between 1 and 3% based on confidence, produces dramatically different outcomes, not because the strategy changes, but because the distribution of size across wins and losses is unpredictable and usually inverted. The trades with the most certainty attract the most size. Certainty in trader psychology is most strongly felt on the trades that have the clearest narrative, and narrative-driven trades frequently underperform structurally identified ones. The result: large positions on trades that lose, small positions on trades that win. The system is correct. The sizing is destroying it. Now add the compounding reality of a losing streak. At a consistent 1% risk, 10 consecutive losses, a sequence every honest trader will experience multiple times across a career, produces a drawdown of approximately 9.5%. Painful and recoverable. At variable sizing averaging 2%, the same 10 losses produce an 18% drawdown. That difference does not sound catastrophic until you calculate what is required to recover from each. A 9.5% drawdown requires a 10.5% gain to return to break even. An 18% drawdown requires a 22% gain to return. The mathematical burden of recovery grows faster than the drawdown itself. Every percentage point of extra risk you take compounds the recovery distance, not linearly, but exponentially. Write that down and post it where you trade. Here are the 5 rules. They are specific, testable, and none of them are in the book your broker recommended. Rule 1. Size down after 3 consecutive losses. Every position sizing framework in print tells you to keep your risk percentage consistent regardless of recent results. The unwritten professional rule is this: after 3 consecutive losing trades, immediately reduce position size to half your standard risk allocation and hold it there until you have booked 2 consecutive winning trades. This is not changing your system. This is protecting the account during sequences where your edge is not expressing itself, which happens to every system, on every time frame, in every market. A drawdown that begins at 1% per trade and drops to 0.5% after 3 losses costs dramatically less than a drawdown that holds at 1% through 10. You are not abandoning your approach. You are managing its exposure during the period when the market is temporarily misaligned with it. The books say, stay consistent. The professional desks say, stay consistent within a drawdown management protocol. Those are not the same instruction. Rule 2. Grade the setup before you assign the size. Not every qualified trade is equal, and professional traders never treat them as if they are. Before sizing any position, ask one question. Does this setup satisfy every criterion on my checklist without ambiguity? Or does it satisfy most of them with 1 or 2 elements that are marginal? Full criteria confirmed. Volume confirmed. Structure clean. No ambiguity. This is a full-size trade. Your standard 1% allocation. Most criteria confirmed. 1 element uncertain. 1 condition you are giving the benefit of the doubt. This is a half-size trade. Half your standard allocation. 0 criteria confirmed, or the setup fails any core requirement. This trade does not exist. There is no such thing as a half-qualified setup that deserves full size. The trade either qualifies or it does not. And within the trades that qualify, the quality earns the size. This is called graded position sizing. You will find it in no retail trading textbook. You will find it in the approach of every serious professional trader who has thought carefully about the relationship between setup quality and capital allocation. Rule 3. Calculate size from the stop, never from the target. This is the most mechanically precise rule of the 5, and it is the one most frequently contaminated by emotion. Position size has exactly 1 legitimate input: the distance from your entry price to your stop loss. Dollar amount you are willing to lose on this trade, divided by the distance in points or pips from entry to stop, equals your position size in shares or contracts. That is the complete calculation. The target plays no role. None. The moment you begin thinking, this trade could run 300 points, Let me take more than my formula says. You are no longer sizing from structure. You are sizing from hope. The target tells you where to take profit. It tells you nothing about what to risk on the way there. Separating those two decisions completely is the difference between disciplined position management and emotionally driven position management. They feel identical in the moment of entry. Their outcomes are not. Rule 4. Set a maximum daily loss limit before you open the platform. This rule exists in the risk management protocol of every serious proprietary trading firm. It does not exist in a single retail trading book I have ever encountered. The rule: before the session begins, determine the maximum dollar amount you are willing to lose today. When that number is reached, trading stops. Not pauses, stops. The platform closes. The charts go dark. No exceptions. No, one more trade to recover. No, the next setup is perfect. Here is what this rule is actually protecting you from. It is not protecting you from the first bad trade. Your stop loss does that. It is protecting you from what happens after the second consecutive loss of the day. After 2 losses in rapid succession, the brain enters a state that is physiologically indistinguishable from mild panic. Cortisol elevated, judgment compressed, the drive to get it back overriding the system entirely. The third and fourth trades of that session, taken from that state, are not analytical trades. They are emotional responses to pain wearing the costume of analytical trades. The daily loss limit makes the decision before that state arrives, when you are still calm, still rational, still capable of choosing protection over desperation. Set it at 2% of your account for most systems. If you hit it, the day is complete. You preserved 98% of your capital for tomorrow. Tomorrow is a session you will trade from a clean state, with full discipline, with no emotional residue from today. That protected capital is more valuable than any trade you might have taken between your daily limit and the closing bell. Rule 5. Recalculate your sizing every session. Never carry a fixed dollar amount. This is the rule most traders violate by doing absolutely nothing wrong. They set a risk amount once, perhaps $200 per trade on a $20,000 account, and then never revisit it. Months pass. The account grows to $26,000. They are still risking $200 per trade. The formula that started at 1% is now running at 0.77% because they locked in a dollar amount rather than a percentage. Conversely, if the account drops to $16,000, the $200 risk is now 1.25%, tighter emotionally, but actually a higher percentage exposure than the system was designed for. The fix is absolute in its simplicity. The only fixed element in your position sizing is the percentage. Before every trading session, recalculate your dollar risk from the current account balance. It takes 30 seconds. It keeps the system proportional to the account's actual state at all times, automatically scaling exposure up as the account grows and down as it contracts. The account's growth becomes self-reinforcing. The account's drawdown becomes self-protecting. The system does what a system is supposed to do. It governs behavior without requiring a decision every time. An amateur sets a dollar risk and forgets it. A professional sets a percentage and recalculates it every morning. Now let us speak briefly about why these rules are uncomfortable to follow, because if they were comfortable, every trader would already be using all 5 without being told. Your brain was not designed for probability-based decision-making under uncertainty. It was designed for pattern recognition in a world where patterns were reliable, where the sound of a predator always meant the same outcome, where a familiar smell always led to the same food source. Financial markets violate this design completely. The pattern that worked last week carries no guarantee for this week. The setup that felt certain this morning has the same underlying probability as the setup that felt uncertain yesterday. Your nervous system cannot feel this truth. It is wired to treat certainty as signal and uncertainty as noise. The result? The trades that feel most certain attract the most attention, the most excitement, and without Rule 1 through 5 anchoring the behavior, the most capital. And those confident, exciting, narrative-driven trades are frequently the ones where the setup quality is lowest, because the narrative is filling in the gaps that structure has not confirmed. Rules without feelings are the only antidote. Not rules you try to follow when you remember to. Rules that are calculated before you open the chart and executed without the option of override. An amateur changes position size based on what the trade feels like. A professional changes position size only when the formula says to. The reason these 5 rules are not in the books is not because Wall Street does not know them. Every serious institutional desk operates with versions of all 5 as foundational risk protocol. They are absent from the retail literature because a retail trader who manages risk like a professional is a retail trader who stops losing money to the institutions on the other side of the trade. An informed, properly sized retail trader is not the target audience for the average trading book. These rules live in internal documents, in firm handbooks, in the conversations between senior traders and their desk managers. They were never written down for you. They are written down now. Survival creates the time. Time creates the repetitions. Repetitions build the edge. The edge, compounded across a properly sized position over a properly managed account, builds the result that most traders spend their entire career chasing and never reach. Not because the strategy was wrong, but because the account was never protected well enough to let the strategy prove itself. Size creates survival. Survival creates time. Time creates everything. If you have ever sized up on a trade because it felt certain and watched it become your biggest loss of the month, type the formula in the comments. And if any one of these 5 rules is something your current system is missing, tell me which one. Subscribe now because the next video in this series covers how professionals pyramid into winning positions, adding size to a trade that is already working, using a specific protocol that scales exposure as confirmation accumulates rather than as confidence grows. The books gave you the entry. These rules give you the survival. Take both.